A ceasefire was declared. Oil dropped 17% in a single session. Mortgage rates in the UK ticked down by a fraction of a point. And yet, on Thursday, just 7 ships transited the Strait of Hormuz, against a normal daily flow of 135. The ceasefire exists on paper. The strait does not yet exist in practice. That distinction is doing enormous damage to markets that had already priced in relief. Brent crude had plunged from nearly $120 to the low 90s on the ceasefire announcement, climbed back above $97 as traders absorbed what Sultan Al Jaber, chief executive of Abu Dhabi National Oil Company, said plainly on LinkedIn. The Strait of Hormuz is not open. Access is being restricted, conditioned, and controlled. Iran's Ports and Maritime Organization published designated safe routes, but only for vessels that first seek permission from the Iranian military. The waterway is also confirmed to be mined. Goldman Sachs, in a note published Thursday, kept its base case, Hormuz gradually reopening this weekend, with Persian Gulf exports recovering to pre-war levels over a month. But it spelled out the adverse scenario with unusual precision. If reopening is delayed by another month, Brent averages above $100 in the second half of 2026. If closure extends further, with regional production losses, the bank's forecast reaches $120 in Q3 and $115 in Q4. The 2-week ceasefire clock is running. Every day that passes without ships moving through Hormuz at normal volumes is a day closer to the Goldman adverse scenario becoming the base case. The market response to this on Thursday was revealing. The FTSE 100 closed down just 0.1%, but the FTSE 250 fell 1%. That gap matters. The FTSE 100 is anchored by BP and SHEL, which rose 3.2% and 1.4% respectively as Brent climbed. Energy majors benefit from higher oil prices in the short run, but the mid-cap index reflects the domestic UK economy, where consumers pay for fuel and heating, where businesses carry energy costs, and where the pass-through from elevated oil into CPI is already beginning to be felt. The FTSE 100's relative calm is not optimism about the UK economy. It is a hedge waiting in crude.
The Iran war arrived in UK mortgage markets with a lag, and it arrived hard. In the first week of March, the average 2-year fixed mortgage rate in the UK was 4.83%. By Thursday, it stood at 5.89%. That is more than a full percentage point in 5 weeks, driven not by a Bank of England rate change, but by swap rates, the benchmark lenders use to price fixed deals, rising sharply as oil-driven inflation fears upended the outlook for rate cuts. The ceasefire produced a fractional reversal. 2-year rates dropped from 5.9% to 5.89% on Thursday. Rachel Springall at Moneyfacts Compare described the move as too soon to call a turning point, noting that lenders were more likely to use the ceasefire as a window to slow down rate hikes than to aggressively reverse them. Swap rates are still hovering around 4%. For that to change, the market needs reassurance on the inflation forecast, and that reassurance cannot come while Hormuz is mined and Brent is approaching $100. This creates a specific trap for nearly 1 million UK households due to remortgage in 2026. They are not waiting on the Bank of England's base rate, which currently sits where it was set before the war began. They are waiting on oil. The Bank of England's governor has signaled rate cuts are likely this year to support a weakening economy, but that guidance was calibrated against an inflation trajectory that no longer holds if energy prices stay elevated. If swap rates remain anchored above 4%, lenders cannot price fixed deals materially lower without absorbing losses. The mortgage market is frozen mid-pivot, watching Hormuz. The UK housing market is already showing the strain. RICS reported this week that homebuyer demand has slumped as borrowing costs spiral. The Telegraph reported forecasts of a summer price slump. A rate cut from the Bank of England, even if it comes, may land too late and too small to offset a borrowing cost that has already risen by more than 100 basis points in a single quarter.
The two threads connect at one variable, the pace at which Hormuz normalizes. That variable now determines the inflation outlook, the Bank of England's room to cut, swap rates, UK mortgage pricing, and by extension, the domestic economy's recovery trajectory. The weight of evidence today leans toward continued pressure. Iran is not simply asking for a ceasefire. It is attempting to formalize a new operating regime for the strait, one requiring vessel permission and designating specific routes around its territory. The IMO's Secretary General called this unacceptable and unprecedented, warning it would set a dangerous precedent. But calling something unacceptable and reversing it are different things. If Iran's toll and permission framework hardens into practice over the 2-week ceasefire window,
the mechanism for reopening becomes structurally more complex than the market's base case assumes. The recovery scenario exists, and it deserves its weight. If the ceasefire holds, if Iran's permission system is quietly dropped, and if tanker traffic through Hormuz returns to even half its normal volume within 2 weeks, oil could give back a meaningful part of Thursday's gains. Swap rates would fall. Mortgage lenders would gain room to reprice. The Bank of England's rate cut path would reopen. The FTSE 250's domestic economy discount would partially reverse. Shell and BP would underperform relative to Wednesday's energy sector surge, but the UK consumer would gain. The verification benchmarks are specific. Watch Hormuz tanker transit counts over this weekend. The Goldman base case requires that flow begin picking up by Saturday or Sunday. Watch UK 5-year gilt yields, which drive swap rates directly. If they drop below 4.4%, lenders will start moving. And watch the ceasefire's Lebanon clause, where the political fracture between the US and Iran is sharpest right now. If Lebanon remains excluded from the truce and Israeli strikes continue, the Iranian side has stated it views that as a violation. That is the scenario where the 2-week clock runs out before Hormuz does.